Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Brian Stutland, Managing Partner at Equity Armor Investments, Francis McKenna, Partner at Larchmont Wealth Management, as well as Vlad Karpel, founder of Yellow Tunnel and Tradespoon. They join me this afternoon to discuss decoding the market, macro sectors, and how to analyze options activities around the earnings season. It is great to have all of you with us, gentlemen. Thanks for joining us on Trade Talks. Brian and Francis, I want to kick it off with you. Let's talk about the macro. Clearly, CPI in focus next week as the market is laser focused on inflation here.
Yeah, it certainly is. And I mean, we've seen a little bit of an indication from this. We got the unemployment report today, unemployment rate ticking up a little bit. The stock market actually liked that because maybe it's now a sign that we can get to a point where the Fed can start cutting. And it should be sort of interesting because the market's just sort of run. It seems like it's never going down. Obviously, that's not the case and always true, but we're in this feel good sense where maybe rates are going to ease and maybe valuations can now go higher. So it's sort of interesting how the Fed is sort of being priced in at this point.
Yeah. And Francis, your thoughts on where we are in the overall macro environment?
Yeah. So, after Brian mentioning the jobs number today, inflation number next week is extremely important. It's expected to be unchanged at 3.1%. But, that being said, Powell has made it very clear that his target is still 2%. Today, after the jobs number, futures are showing that for the March meeting, we're not going to cut, only 3% chance. In May, it's going to be a 27% chance after today. And in June, it's factoring in a 98% chance. So the market is pricing in a cut in June after today's jobs number. If we get a lower CPI, let's say below 3% next week, May, that 27% will probably jump up a lot.
Yeah. And what about corporate cash? We're seeing that that's on the rise. And we're also seeing, the moves in money markets as well, considering where interest rates are.
Yeah, absolutely. And it makes a lot of sense. I mean, the one thing you don't want to do right now is sit in cash. In 2020 and 2021, the one-year Treasury bill, for example, was at about 5 basis points. And today it's close to 5%. 3 months is at 5.38%. 6 months is at 5.3%. In U.S. Treasuries alone. So if you take a gain in the stock market, if you have an event or you're just building up in cash, it's important to at least put it in some type of money market vehicle. If it's a Treasury agency or a money market ETF.
And as we're thinking about income and yield here, what about preferred stocks? Are they attractive at this point?
I think the 1,000 bond preferreds are extremely attractive right now. Preferred stocks in the 25 par space are, in my mind, expensive. So they're trading at about, let's say, 5.5% to 6% in the 25 preferred stock space. The 1,000s that are coming to the market right now, as you see in the screen, they've come recently to new issuance. Citi came in the last couple of weeks at 7.2%, JP Morgan at 6.875%, State Street at 6.7%. It's important to in my mind, when you're getting bank exposure, to look at GSIBs, globally systemic important banks. Those are all on the list. And then real solid utility companies like Nextera recently came at 6.7%, and BP Capital came in at 6.45%. I think this is a great way to, get some yield, get some duration. So when we start cutting rates, you're locked into these coupons at, with call protection of either 5 or 10 years in some cases.
Mm-hmm. Yeah. And Brian, I want to bring you into the conversation here and tie this into the volatility markets as it relates to VIX, and then also what you're seeing in terms of spreads tightening. Is there any correlation there?
Well, yeah, I mean, I think it's interesting because you see this big pile of cash that's building in money market funds. Francis mentioned other alternatives to look for to sort of get additional yield. And people have gone into other places. They're moving into sort of that higher credit rated or worse credit rating type corporate bonds. And we're starting to see those corporate bond yields start to tighten. The spreads between the 10-year of a U.S. Treasury and let's call it a BAA rated bond and the corporate bond, we're starting to see those spreads tighten and continue to trend lower here. And so as we've done that, the stock market actually likes that a lot. The market loves to see those credit spreads tighten. When we get that, what we've noticed is that basically we've seen rallies, right? Let's go back to 2016 when sort of those credit spreads started to tighten, the market gained some more confidence. The stock market had a huge run in 2016 and 17. Same was true for 2021 into 22. And now, once we sort of saw that bubble burst on the credit spreads, that's what triggered sell-offs in the market. And I think what typically will happen is you'll get this volatility spike in the VIX. You'll see volatility sort of creep in. We'll lose some liquidity in the market. And if we've ever seen the VIX sort of double in value off its lows, what happens is credit spreads start to widen back out. The market starts to see some volatility. That's something to watch. Look here, the VIX has been trending higher, even though the market has gone higher in sort of this recent last couple of weeks here. So this is something to watch, because if we get any sort of explosion in volatility, that could create some concern in the bond market, and that ripple effect could trigger into other areas of the market, specifically the stock market.
Right. And Brian and Francis, I want to get your thoughts on this. A big narrative for 2024 has been concentration in a handful of stocks, right? So there's concentration risk in the market. Let's pull up a chart here on the Nasdaq 100, because we know the Magnificent Seven clearly has a big weighting within that index. From a technical perspective, does this still have more momentum? Is there more room to run here?
Yeah, I mean, I think it was interesting here. The Nasdaq, basically, you're going back at the end of 2022, formed this nice head and shoulders bottom. It broke out, had about a 3,500 point rally to the upside, consolidated again, and then we broke up to another level higher. I expect it to sort of trade above that 19,000 level. That would be another 3,500 points since the last consolidation period here. So I think there's a real chance that there's maybe still some upside here. And maybe that coincides with a sell in May and go away with the markets. The momentum is just to the upside. Typically, end of March, end of a quarter. Then we have earnings in April, and really earnings, like we mentioned before, Jill, a month ago, earnings are driving the situation. That may drive the Nasdaq basically continuing on to new all-time highs. So I kind of expect that 19,000 to 20,000 level before we take a pause again, and then we'll see where things go.
And just to add to that, in 2023, the Nasdaq was down, getting hurt. A lot of it had to do with the rise in interest rates. In 2023, we were obviously hiking rates. We're expected, obviously, to start cutting now. So rates dropping should help support the Nasdaq, maybe have some more room as well.
Yeah. And before we bring Vlad in to discuss some option strategies, I want to focus on sector specific for a moment here, particularly the consumer. It's interesting. The quarterly Charles Schwab Investor Sentiment Survey came out, and it launched in 2021. And this particular quarter, investors felt the best they have about their portfolios and their investments. However, the survey also indicates that they are, a bit squeamish when it comes to the economy, yet consumers still spend. So let's debate the consumer here, right? What areas within the broader consumer space look attractive? And what are your thoughts in terms of momentum with consumer strength here? Brian, we'll start with you. Francis, I want to hear what you have to say.
Yeah, I think when it looks at the consumers, the same story and picture is kind of going on with the general broad market, where we're getting this consolidation, and really just the top holding names are moving the market higher. And this goes for consumer stocks. When you look at consumer discretionary, we're talking about Amazon, the top weighting in the XLY. In consumer staples, the top weighting, Procter & Gamble, the second one really close behind it, Costco. Those two have had tremendous years so far, year to date. It looks very similar. Everybody talks about the Mag 7 in the NASDAQ, the top holdings there driving the market. Well, the same is true when you drill down into sectors. And we're seeing that thing, sort of the market, not broaden out. It's actually getting narrower and narrower. So I think that's rather interesting that we haven't really had the other market participants take place in this consumer run here. If you look at everybody else, it's pretty much kind of flat here. It's really just a couple names you really want to be in.
Yeah, just looking at it again in a rate perspective, the rise in interest rates hurt sectors like automobiles, for example. If you look at a Ford chart, for example, in the last year, it's literally flat. Airlines, cruises, those types of areas. When interest rates start to come down, it should support the consumer and discretionary sectors like that.
Yeah. Well, Brian, let me ask you then, from whether it's a valuation perspective or companies that have the right exposure to the right areas within the consumer space that you're bullish on, give us an example of a couple companies that look attractive.
Yeah, I still think we are overweight large cap value in our portfolios for clients. And I think that holds true for certain sectors. I think you want to really be on the heavier weighted side of things and the bigger market cap, because in this higher interest rate environment, they have so much better buying power than most companies. And whereas, corporations are building cash, these companies are flushed with that and have ways to spend and sort of cut prices, keep margins, somewhat tight, and continue to build. And I think, to the point here too, when you look at something like an Amazon, which also has the cloud computing aspect and the AI play, that's really helped it on that side. And then I think in terms of heavy consumer discretionary luxury, I mean, Francis mentioned it's been a tough sled for the autos, for the cruise ships, anything really luxury brand has been tough. And I think that's why on the staple side, you see names like Procter & Gamble and Costco doing so well this year.
Mm-hmm. All right. And Vlad, let's bring you to the conversation right now for some option strategy here. Let's talk about how option strategists use information that they're getting from the options market around earnings season. We'll use Adobe as an example, well-known name, plenty of liquidity here. Let's start off.
Yes, thank you very much. Yeah, it's been a very volatile season in terms of the earnings, and there are different approaches. You can be long volatility or you can be short volatility when it comes to the earnings. So we do have Adobe earnings next week, and we'll go over through some of the data. But what I've noticed is that there's definitely a theme, artificial intelligence. So if there's any stocks that has AI, then you could have these outsized moves. So we had Dell last week, or we had Antap last week, where the stock moved beyond 2 standard deviations. So usually if you look at the past 8 quarters, you can actually see that the stock moves within 1 standard deviation. You can go to a Nasdaq website, pull up an option chain on Adobe or on NVIDIA, and actually see what is the 1 standard deviation move looks like and what is the 2 standard deviation moves. So historically, 2 standard deviation moves happens very rarely, maybe 2% of the time, maybe 3% of the time. Because of this kind of, I don't want to say irrational exuberance, a lot of people are, especially retail investors and institutional as well, are buying calls. You can see it in NVIDIA, you could see Dell going into the earnings. You can also see it in Antap. And if you look at the bell-shaped distribution curve, you can actually see an open interest, right? The most important is, even if you're not an option trader, you can go into a specific strike price, specific level, and see where's the highest open interest. So let's take a look at the Adobe. So I'm looking at the Adobe, and you have a gamma exposure, Vanna exposure. Probably don't have a lot of time to go over that, but the most important to look is the bell-shaped distribution curve. So right now, Adobe is trading at $553. It's announcing earnings next Thursday. And then in terms of open interest. So you see at the 500, there is a very large negative Vanna, basically meaning that people are selling puts predominantly. They're selling 500 puts, which is a 1 standard deviation away, 50 points away from where it is now. And on the other side, at the 600 call, you also have a very large open interest, meaning that people are buying calls. The risk reversal is a very popular strategy where people are selling puts and they're financing to buy out of the money calls. So if you go to Nasdaq website, you pull up an option chain on Adobe and you look at next Friday's expiration, you can look at the implied volatility based on the demand and supply for options data. And you can see, I did this quick calculation, that if you look at the money straddle and out of the money strangle, right now, based on the current price level and based on the current volatility level, it implies 7 to 8% move between now and next Friday. 7 to 8% of $500 stock, roughly 45 points. So that's how you get to the 600 strike and 500. That is a 1 standard deviation move. 67% of the time, it should trade within this range. But this earnings season, because there is so much demand for AI stocks, a lot of people buying call at 650 level, right? You see a large negative Vanna. That usually means, if you look at the vol skew, which is less than 0.5, meaning that people, just like NVIDIA, just like Antap, they're buying a lot of calls, also at 650 level. And they're also selling a lot of puts at the 470 level. So if you look at this as a bell-shaped distribution curve, these 2 standard deviation moves that happens only maybe 2 to 3% of the time now happen maybe 8 to 10% of the time. So there are a lot more probability that if Adobe misses earnings, let's say forward guidance, just like Palo Alto last week, right? They're also considered to be AI stock, cybersecurity. There was huge demand for the calls and selling pulls, same thing in Dell. But their forward guidance they missed on the forward guidance. And then you right away have a 20-25% sell-off in Palo Alto because nobody was hedging, nobody was buying puts, and people were selling puts. So same thing could happen to Adobe. If they beat on all the bottom and top line and give a positive forward guidance, we could see 2 standard deviation move. Instead of moving 40 to 50 points, it could move to the 650 strike. And the reverse is true. If they guide down, despite the beat on the bottom line or top line, you could see instead of a 40 to 50 dollar move, it will move close to $100, 2 standard deviation. So you can take advantage using option strategies. Iron condors is very popular if you want to short vol. I propose, because of the CPI data and PPI data next week and options expiration, which could cause a lot of liquidity issues if you have negative surprise on PPI, let's say, and you have VIX expiration and monthly option expiration, you could have these 2 standard deviation move. So you can have kind of a long, it could be long vol. If you think it's going to beat the earnings, you can select a butterfly around 600 or 650 strikes. And if you think they're going to miss, then you can select a butterfly at 500, 450. If you're not sure, like most people don't know if they're going to be there or not, then you can do butterfly on both sides. It's a relatively inexpensive way to look at these probabilities, right? Because you have a distribution of probabilities, you have supply and demand for certain strike prices, and then you can express either bullish sentiment or bearish or neutral. So that's what I see in earnings season this season, and I think it is definitely, you have extreme moves. If you're just like NVIDIA, if you do great during earnings call, then the stock moves 2 standard deviation to the right. And if you have any negative guidance or you missed earnings, then you have 2 standard deviation to the downside.
All right, Vlad, we appreciate the insight. Certainly lots of option strategies presented to you by options. And of course, if anyone has any questions for Vlad, you can follow him on Twitter and connect with him directly at @tunnel_yellow. It was great to have you with us, Vlad. Brian, take us home here. Any final thoughts as we go into next week?
Well, I think it's definitely going to be interesting. One, we have, quad witching, basically options expiration, the 3rd week of March coming up, which is going to be huge, with the CPI number coming out next week. So I'll be watching that to see if there is a hit or a miss or exceed, because that will probably, garner where rates are going to go and where people are feeling about this market. So any sort of, softish sort of number on the CPI number, that should continue to take the market higher. But if people get caught by surprise, be careful, because we've seen volatility start to tick up. So that's a little bit of a concern, and that's why I'm protecting positions headed into this.
All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.